afternoon, everyone, and thank you for joining today's webinar series. My name is Tyson Mavar, one of the ExxonMobil focused retirement advisors for the retirement group here in Texas. And today's webinar, we're going to cover some important topics for folks that are approaching their retirement from ExxonMobil, specific to retirement withdrawal strategies, tax strategies, and the interest rates that affect the pension lump sum for ExxonMobil employees. For those of you who aren't as familiar with the retirement group, we're an independent financial planning company that specializes in helping corporate employees plan for retirement, and we manage retirement assets for our clients that have left ExxonMobil and a number of other companies around the country. We happen to have been around for about 30 years. We are not in any way affiliated with ExxonMobil, nor are we affiliated with Voya. However, we have many clients going back to the early 90s that have retired from ExxonMobil and some of the heritage companies, and we feel very confident and comfortable assisting somebody through the transition process from active employee to comfortable retiree. So we have a whole host of different services, complementary services. We're going to drop some links into the chat box today to give you access to any of these that you might be interested in taking advantage of. Those include links to our ExxonMobil retirement planning page, our ExxonMobil retirement guide, our webinar series of recorded webinars in our LinkedIn page you can access and peruse at your own leisure. Access to the cash flow analysis that we do complimentary for everybody at ExxonMobil, whether or not you're a client yet. Access to some of the other tools and planning options that you have through our website, such as the NUA analysis, the Social Security analysis, and a variety of other complementary resources we encourage you to take advantage of as you approach your transition from the company. If you'd like to spend some time with us after today's webinar, we'd love to spend a few minutes with you, whether it's on the phone, via web meeting, or even in person, to talk about your personal situation and hopefully guide you in the right direction on things you should be focusing on as you approach your transition from the company. And we'll give you a way to get in touch with us at the end of today's webinar. If you do have questions, feel free to ask them in the question and answer box, and we'll try to get to all of them at the end if possible. And certainly feel free to give us a call if you just have a quick question that you'd like to spend a little bit more time and get some more detail on. So we talked a little bit about our company and some of the resources that we have available, but if you, regardless of where you are in the country or where you are in the world, I have clients that are working overseas right now, please do not hesitate to take advantage of our complimentary services. Even if you already have an advisor, maybe you plan on doing everything on your own, or maybe you just want to get a second opinion, we're delighted to spend some time with you. Here's the QR code for our LinkedIn page where you can follow along some of the different strategies that we talk about specific to the ExxonMobil retirement benefits, and how to get access to one of our calendars, whether it's mine or one of my colleagues that focus on the ExxonMobil retirement strategies. We're delighted to spend some time with you. Now, we have quite a bit to talk about today, so we're going to get right into it. There's been some changes happening in the tax code related to retirement rules and regulations, and there's likely going to be some more later this year. We'll be doing webinar series talking about Secure Act 2.0, which will likely further change required minimum distribution ages, as well as distribution and contribution rules to retirement accounts. So stay tuned for more of that. But what we already know is what has happened in the last couple of years as it pertains to the original Secure Act. The first change that resulted from the Secure Act was change in the RMD age, the age at which you have to pull money from your retirement accounts and have to pay taxes on those distributions. It used to be 70 and a half. They moved that age to 72 for anybody that turned 70 and a half after the end of 2019. But stay tuned on this, because this age is likely going to be changing, maybe in the not so distant future. And this is actually an advantage if you can wait a longer period of time before you're forced to take distributions from your account. You have more flexibility in managing your tax bracket. We'll talk a little bit about different withdrawal strategies that might allow you to keep more of your money in retirement toward the end of this webinar. Now, one of the disadvantages of the previous Secure Act was that we are no longer able to stretch out distributions on an inherited retirement account if we are a non-spouse beneficiary. So usually this is our kids, but it doesn't necessarily have to be. We're no longer able to stretch out those distributions over our lifetime. We have to accelerate those distributions to a 10-year period after the death of the original cow owner. So this could be for money you're inheriting from family members or money that you're planning to bequeath to your family members or different causes that are important to you. Now for non-spouse beneficiaries, they have to spend all of the money, or at least take that money out of the retirement account and pay the ordinary income taxes that are owed on those inherited assets within 10 years of the inheritance. Now, everybody's different in terms of their tax bracket. Oftentimes, it makes the most sense to evenly spread out those distributions over the 10 years to avoid going into a much higher tax bracket, but that's not always the case. And this could be a reason that you may want to update your trust or at least your overall estate plan. And that's something that we like to focus on with our clients in making sure that their family can keep as much of their money as possible if there's any money left over in their retirement account beyond their demise. Now, we can now also contribute for a longer period of time to IRAs. It used to be you could no longer contribute to an IRA after 70 and a half. New rule is that you can, as long as you have earned income. You can't contribute to a traditional or Roth IRA unless you have earned income, which is different than ordinary income when you're pulling money from a retirement account, or Social Security income also does not qualify as earned income. But this is great for the folks that continue working past age 70. Good way to get some tax deductions potentially. And this is something else we'd want to focus on when we run that cash flow analysis. I'm going to zoom in on the tax brackets for 2022. It's very possible, if not likely, that these are going to change as soon as next year. But this is our progressive tax system, wherein the more income we have, the higher tax bracket and more taxes we pay throughout our life and also into retirement. So whether we're taking our pension as an annuity, whether we're taking the lump sum, rolling it over to an IRA and withdrawing money from that, this is what we want to be very aware of when we're taking money out in retirement, because we try to avoid taking out too much money in any given year to avoid jumping up into a higher tax bracket. Something else that we've been focusing a lot on with our clients is considering Roth conversion. With the likelihood that tax rates could be going up throughout a retirement, and with the majority of our clients having most of their retirement wealth in pre-tax accounts that'll be taxed at some unknown future rate, this could be a great time to start taking more control of your taxes in the future by considering Roth conversions, where you move money from either your 401k or a traditional IRA to a Roth IRA, pay the taxes. You never want to do too large of a conversion in any given year, but there's no limit to how much you can convert in a given year. And this is why we'll use these tax brackets to strategically see what conversion might make sense, how much of a conversion might make sense. Normally we do this toward the end of the year when we have a good idea of what our total income was for the year. But another good time to do a Roth conversion is when stocks are down. If we predict that those stocks will eventually recover, by converting that money while they're temporarily down, we can get a cheaper rate on the conversion. We pay less taxes on the conversion of a given amount of shares. And we also get tax-free growth on the rebound when those shares eventually recover in price. So it could be a decent time to consider this. And certainly toward the end of the year is when you want to start to review whether or not it might make sense this year to do a Roth conversion, and maybe do this for several years throughout your retirement, at least until you become eligible for required minimum distributions, wherein Roth conversions don't make as much sense usually because you cannot, unfortunately, use your RMD as a Roth conversion. You would have both an RMD and a conversion, which could give you quite a bit of income in any given year. I'm also going to focus in on the long-term capital gains rate. So these rates are also for qualified dividends. This comes into play if you utilize the net unrealized appreciation strategy for some of your low-cost ExxonMobil stock when you leave the company, both in potentially getting a lower tax rate on your dividends, but also getting a lower tax rate on the appreciated portion of the value of your ExxonMobil shares. Most of you are probably going to fall into a 15% dividend and capital gains tax rate, which for most of our clients is a discount on what their ordinary income tax bracket is. As you can see up here, you might be in anywhere from a 22 to a 35% tax bracket, depending on your income or whether or not you file jointly. So this is another great way to be strategic about which accounts you're pulling money from in retirement, how much you're pulling from, and without changing your total cash flow, change how much you're paying in taxes legally throughout your retirement. We're delighted to help you with these ideas. Something else that our clients often do in retirement is consider moving. And it might be a good idea to look at the tax rates in the state where you might reside in retirement, whether you're moving to get closer to your children, closer to your grandchildren, maybe you're moving to get further away from your children, whatever the case may be, maybe downsizing in retirement, maybe getting away from the city. This is important to consider before making the move. And our cash flow analysis will allow you to compare different states and what that does to your money over time, just based on not only the tax rates you would pay in a different state, but also the cost of living that varies from state to state. We've seen a lot of people leave the states of New York and California in retirement, and many of them coming to here in Texas, where not only is the cost of living lower in some cases, but tax rates are substantially lower. And there's a lot of places to live that aren't as close to the city, might be a little bit quieter. So we strongly encourage you to think about this prior to retirement. And you may not know where exactly you're going to live, but by considering lots of different results or outcomes, you can better prepare for what that next step might look like. And it's going to make retirement a lot more comfortable in our experience. Tax rule changes, proposed and current. We're going to go through some of what's happened in the last couple of years and what could be on the agenda in the next couple of years. So we saw some major government stimulus in the last couple of years, in part due to the COVID-19 pandemic. And we saw some changes to tax rules as a result of that. And we'll probably see more as a result of spending money that we didn't have for the most part in the last couple of years, and having to in the future finance some of these previous obligations that we've created. So a lot of these CARES Act provisions have expired, but some of you may have taken advantage of them and may still be utilizing these or paying back some of the taxes that you may have used to bridge the gap between jobs, or maybe even invest money when interest rates were low, maybe buying property or moving during that time frame. And we've seen likely resulting future changes to the tax code that are maybe going to happen as soon as next year, 2023. So raising the top marginal income tax bracket back to 39.6%, close to where it was during the Obama administration, and probably raising not just the top tax bracket, but a variety of different tax brackets. Changing the long-term capital gains tax rate. We saw the differences on the previous slide, making long-term gains taxable as ordinary income, which is currently what short-term capital gains are. If you sell an asset within a year of purchasing it and you sold it for a gain, you'll be in ordinary income tax bracket, whereas if you held it for longer than the year, it's considered long-term gains and you get a little bit of a break on the taxes. That may not be the case for much longer. Also, what is currently known as a step up in cost basis. When you pass away with an appreciated asset, your beneficiary does not have to pay long-term capital gains rates on the appreciation that you received during your lifetime. That might not be the case for much longer, where they could be taxing unrealized capital gains at death. So you might not be able to inherit as much money on an appreciated asset that you inherit, or your beneficiaries might have a big tax liability on any appreciated assets, such as your home. Appreciated ExxonMobil stock are probably the big ones that we see with our clients. And we need to build this into the plan and pay close attention to what happens toward the end of the year to what is currently known as a step up in cost basis, to see if that goes away and how you might want to rearrange your retirement plan as a result of that no longer being a part of the tax code. Applying what is now known as the net investment income tax to active pass-through business income. Currently, this is for gains and dividends for high income earners. Anybody who's married filing jointly with income more than $250,000 this year is going to have an additional 3.8% on their dividends and capital gains. Now, this is currently already the case, but it's being talked about also applying this toward active pass-through business income. So we want to pay close attention to this as well, especially if you're considering opening a business in retirement. And some other changes resulting from some of the stimulus bills that may or may not be extended, but it's also going to affect people differently depending on what income tax bracket you're in retirement. These are things that we want to pay a lot of attention to as you approach retirement to make sure you're not making any big mistakes in terms of overpaying in taxes. Now, let's talk a little bit about IRA tax planning. Now, many of you know that your pension lump sum is a function of both your age or life expectancy, as well as interest rates. And these are the interest rates that we've seen in the past and what we're predicting in future quarters. So on top of this table, we see February and March. Those are known rates that are applied toward the third quarter retirees. So below this, you can see Q3 2022 blended rates. Those rates have been known. Many people retired at the end of May to avoid these higher rates. You can see Q3 compared to Q2. They're 50 basis points or 0.5% higher for the grandfathered folks. The second segment rate is the most important for the folks that are on the corporate bond interest rates. And you can see those jumped almost 80 basis points, actually 81 basis points specifically, or 0.8%, which might have been an 8% drop in your lump sum. So you have $1 million lump sum. You might have lost $80,000 overnight from the second to third quarter. Now, we do not yet know what the fourth quarter interest rates will be. However, you can see at the bottom here, we have the Q4 trend, May rates. The fourth quarter is based on May and June interest rates. At the end of July, they will publish the June interest rates. And at the same time, they will update your ExxonMobil pension modeler that you can access through the EDA website or going through the ExxonMobil benefits website. Now, look at the May rates. The second segment rate, 4.59. That's already more than 1% higher than the third quarter rates, which were 80 basis points higher than the second quarter rates. So rates have already gone up 1.8% in less than 2 quarters. That might be close to a 20% drop in your pension, depending on your age. And it could get even worse for June. And this is why it's very important, folks, to pay close attention to these interest rates. I have many clients that were planning on working several more years that are now considering leaving ExxonMobil and going to consult or contract so they can continue to have income, but avoid losing hundreds of thousands of dollars in many cases on their pension. Not only avoid losing money on their pension, but actually get access to those dollars so that they can invest them and earn some interest, even in a conservative environment, earn some positive interest on that money rather than watching that pension lump sum erode every quarter, potentially going forward until they retire. That's a big risk at staying at ExxonMobil right now. So if there's a possibility you could see yourself doing something else, working or otherwise, now is a good time to rerun your plan, see what you stand to lose in your lump sum, and see if there might be a better way to leave the company. It might mean changing the timing of your retirement, might also mean changing the option that you take on your pension, maybe considering taking a portion of your pension as an annuity. And these are issues that we go through when we run the cash flow analysis, comparing different retirement dates and comparing different pension payout options. So you can spend some time thinking through what is likely going to create a comfortable retirement for you and your family, depending on your situation, risk tolerance, life expectancy, your plans for cash flow needs in retirement, how much you need in early retirement versus late retirement, your tax bracket status. All of these things should play into which option you take on your pension. And you need to spend a lot of time on this well in advance of pulling the trigger on retirement, because I will promise you, for most people that I've talked to, it's a stressful transition to leave the company that may have been paying you paychecks for several decades. It's going to add a lot of stress when you have really big, irrevocable decisions to make. So plan early and plan often is the best advice that we have. And we're delighted to help you run projections on the pension modeler, which a lot of people aren't as comfortable with how to do this and how to model different interest rate assumptions and different timings on the retirement. So let us know if you'd like to have us join you on a call to go through a couple different pension projections to help you plan for your retirement. Now, some other strategies that we focus on with people have to do with the transition of their assets, moving both the lump sum pension into a traditional IRA. You may have a supplemental pension plan and or a supplemental savings plan, which become taxable at retirement, and you do not have the opportunity to roll over and defer taxes on. You may have some after-tax money in your savings plan. We talked a little bit earlier about the NUA strategy. You might have some low-cost stock that would better serve you by removing from the retirement account framework and putting into a non-qualified account so as to get a better tax rate in retirement. These are other issues that we'd address with people prior to leaving the company and certainly prior to moving any money from the company. And we want to make sure we do this tax efficiently, folks. Some of these decisions are irrevocable, and we've seen many cases of people making really big mistakes that cost them tens of thousands of dollars, if not more. So just understand all the tax rules and understand the pros and cons of moving money from your 401k as well as your pension. You may want to leave your pension at the company after leaving the company, maybe if it's because you still have age penalties. And you also may want to leave your 401k there, but there's different issues that will help you identify what's going to be best for you and your family. And most of them are related to taxes, but some are related to the benefit plan rules. If you do have after-tax money, it usually makes sense to move to a Roth IRA to earn tax-free growth on your earnings going forward. Not always, but in most cases. And the pre-tax money in your 401k, you probably would like to move eventually to a traditional IRA. The reason most people do this is because you have more investment options in a traditional IRA. You also have more flexibility to pull money from that account. 401k plan, for most people, you only get one withdrawal per year, which is not very flexible. Whereas IRAs, you can take money out monthly, twice a month, every day if you want to. There's no restrictions on the frequency of withdrawals. And there could be some tax advantages to rolling this money over, like we talked about NUA and a Roth conversion. Those are all reasons that most people will eventually roll their 401k over to an IRA after they leave. But you also want to be careful before you do this, because there may be some arguments to leave it there, at least for a period of time prior to doing your rollover. Now, something that could also help you have your money last longer in retirement, keep more of your money by paying a lower tax rate, is just by being conscious of the tax brackets and what we think of as a tax-informed withdrawal strategy. Conventional wisdom used to be that we spend our taxable assets first. That's money that's in the bank, brokerage accounts, non-qualified investment accounts first, because they do not enjoy tax deferral. So they're less valuable, some people used to argue. Then second order of operations, spend our tax deferred money. That's our pre-tax assets, our pension lump sum, our traditional IRAs. And then lastly, we want to spend our tax exempt funds, or our Roth money, tax-free growth money, last, because it enjoys tax-free growth and we want to allow that to happen for as long as possible. We've done an example here of somebody that went through this conventional wisdom where they retired at 65 and it looks like they passed away at 95. In their case, they only had about a year, almost 2 years worth of taxable assets that got eaten up pretty quickly. Then they moved over to their tax deferred assets, as well as had Social Security to cover some of their expenses. And then eventually at age 83, they had spent through all their traditional IRA or tax deferred money. Then they moved over to their Roth IRA. Total taxes paid for this individual over this period of time, $36,402. Now, we've done another example of the exact same individual, same asset, same retirement age, same Social Security claiming age. The difference being, what we try to do is fill up their lower tax brackets with pre-tax withdrawals from a traditional IRA. It was a source from their pension lump sum or their 401k. And then have their taxable money lasting longer by only utilizing it when they get up to a certain tax bracket. So for example, year one, they spent about, looks like just under $30,000 of pre-tax money that was taxable. And then the rest of their income for the year, they took from an account that they had already paid taxes on. This allowed them to stay out of the next highest tax bracket, and also allowed them to keep their non-qualified money for, it looks like, 6 years until they dipped into their tax exempt money. And you can see this allows them to stay in a much lower tax bracket. In this case, they got 2 extra years of income. In other words, rather than running out of money at 95, they didn't run out till 97. That's a pretty big deal. And the total taxes, especially for somebody who has income that's double or triple what this example is showing, it becomes an even bigger deal to avoid those really high tax brackets. So the distribution strategy becomes very, very important, and not just setting up a plan and then going throughout the rest of your life toward that plan. It doesn't work that way, unfortunately. You have to revisit this at least on an annual basis, whether you're doing this on your own or working with a retirement advisory firm that specializes in just this. developing a withdrawal strategy that's tax informed. This is going to keep you out of trouble in retirement and help you to keep more of your money just by structuring your withdrawals in a different manner. So just highlights of this withdrawal strategy: fill up lower tax brackets with tax deferred income each year. Be aware that Social Security is taxable, and that could also be a function of when you decide to take Social Security, how that affects your total taxes each year. And then strategically utilize your taxable and tax exempt, or your brokerage account and your Roth IRA money, to supplement your income needs and maintain the lowest tax bracket possible throughout your retirement, not just the early years of retirement. And now there are some potential penalties of taking money out before 59 and a half, but fortunately there's a special part of the tax code that is, it's number 5 on this list. It's part of the tax code called 72T, wherein you can take withdrawals from your 401k and or pension without any penalties, as long as you left the company on or after the year you turn 55. So as long as you work at ExxonMobil until the year you turn 55, you can even retire at 54 as long as you turn 55 later in the year. You can withdraw money once a year from your 401k plan, penalty free. You still have to pay taxes, but you avoid the 10% additional early withdrawal penalty. Very important for somebody that's either leaving the company before age 59 and a half. Maybe you're working a part-time job and need to supplement your income needs, or maybe you're going to take a year or two off after you leave ExxonMobil before you go back into the workforce. This is a great way to do it. And as it turns out, that is also the key age to qualify for most retirement benefits, 55 and 15, as most of you know. So that could be a good target date to run your projections if you're somebody that's considering leaving the company, whether or not you're actually retiring. We encourage you to run the numbers at 55. 60 is another good target date because that's when age penalties go away on the pension. And probably one other date that might coincide with some important factors. But keeping in mind that interest rates are affecting your lump sum, this likely is going to be, at least in part, a catalyst for your retirement time frame and what's happening with interest rates, if there's any possibility you plan on taking a lump sum on your pension. But there's some other ways to avoid penalties. We have a list of them here, and we'd like to help you build these into your plan if you qualify for any of these, to again allow you to keep more of your money by avoiding penalties on your withdrawals. Now, from the ages of 59 and a half to 72, you do not have any required withdrawals. You can take as much or as little out of your retirement accounts as you choose. But then again, at 72, they start forcing you to take money out. And the penalty is severe if you do not meet the required minimum distribution. The penalty is 50% tax on top of the tax you would pay as ordinary income for any withdrawals that you needed to take out by law but did not. I have an example of one of my clients. It was not his own IRA, but it was an inherited IRA that he inherited from his father. It was at Vanguard. They never told him he was supposed to take money out. He didn't know. 10 years later, he came to one of our seminars, found out that he was probably not doing what he was supposed to be. And we found out that the penalties over that 10-year period amounted to about $290,000 of money he was supposed to take out and didn't. Is what the penalties came out to, plus interest. Now, we were able to work with his CPA and essentially make an argument that he was not informed about this. He had done a good job paying his taxes on time in the past. And fortunately, we were able to get these penalties abated. But that's not always going to be the case. The IRS, especially with the amount of debt that we've accrued, is probably not going to be as gracious going forward in giving you a second chance on the mistakes that you may have made. So pay a lot of attention to this, folks. Build it into your plan so you can take advantage of the flexibility you have from 59 and a half to 72 to maybe do some Roth conversions or be strategic about your withdrawals, and make sure that you're taking advantage of the tax code, especially after you leave the company. Unfortunately, statistically, we've found that 74% of Americans do not have a written plan for their retirement, which is absolutely atrocious. This is unacceptable, folks. Just by joining this webinar, I know that you at least have some foresight to know that there's things that you probably want to be paying attention to as you approach your transition from the company, and take advantage of the cash flow analysis that we do complimentary. There's a lot of companies like ours that will charge you thousands of dollars for a written plan like this that we are not going to charge you on, because we want to develop a relationship in hopes that you might do some business with us after you leave ExxonMobil. So take advantage of that. If you have any questions, we're going to answer some of the questions on today's call, but here's some of the things that our clients have told us that are important to them about who they choose as an advisor. The cost of service is certainly a big one. Does your advisor understand the benefits plans, pension, health, 401k? Are they working with an experienced team that can help them manage the investments, but also help them keep up with the changes that are happening? What value are you getting from the relationship? And is it worth the cost of the service? And then ultimately, do they run a detailed financial plan and not charge you for it? We think all of these are boxes that you want to check when you're shopping around for advisors after you leave or before you leave ExxonMobil. Here's our phone number. If you'd like to ask any questions specifically or schedule a call with us, you can email us at info@theretirementgroup.com. Call us at the home office at 800-900-5867. Here's a QR code to schedule a meeting with myself or any one of my colleagues that work with ExxonMobil clients. And again, that LinkedIn page where we produce this content and have recorded webinars you can watch at your own leisure. So with that, we're going to wrap it up, but I'm going to see if there was any questions on today's call. We'll try to get through. We kind of got a little long-winded today, but we'll try to get through a few if there were any. And it looks like there were. All right. So the first question, if I want to take a loan for my 401k, how do I do it? One follow-up question. I'm investing in Exxon stocks through 401k. In this case, how to know how much money, how much amount of money can I take as a loan? Okay. So to take a loan, while you're working, you cannot do this while you are retired if you still have a 401k plan, but while you're working, you could do this through the Voya website, or I recommend calling Voya, requesting a loan, which, as it turns out, you could have multiple loans, but they cannot exceed the lesser of $50,000 or 50% of your 401k value. So if your 401k is over $100,000, the maximum total loan amount would be $50,000. It's unique how ExxonMobil does not reduce the balance by the value of the loan. So your money is still invested. However, if you retire and do not pay off that loan, it's going to reduce the balance and also make that money taxable. So we will help you with paying off your loan at retirement and the ways that you have the opportunity to do that. There's 3 of them. But it's a good source of income for some people that need some extra cash and don't want to pay the bank interest, because effectively you're paying yourself back in interest as you pay that back through your contributions. Another question, once retired, can you take ExxonMobil stock dividends without triggering withdrawal event, jeopardizing NUA option? Great question. So for those of you that understand the net unrealized appreciation strategy, when you retire, this is a triggering event, meaning you are allowed to utilize NUA. If you take money out, however, this will potentially ruin this triggering event if you don't utilize NUA by the end of the year you took money out. If you have another triggering event, such as 59.5 or death or disability being the others, you may have another opportunity to do it in the future. But this is why you have to be careful about taking money out after you leave, because you could destroy the tax strategy known as NUA. The question, though, was if I take my ExxonMobil dividends as income, where they send them to you quarterly into your bank account, does that constitute a withdrawal? And it does not, fortunately. So you can turn on income from your dividends without taking a distribution from the account, still preserve the ability to do the NUA strategy while still getting some income from your plan. It could be a viable option for somebody, especially if you've already passed the 59.5 triggering event. Another question, do you know what the rates are and if they'll affect my Exxon 401k value? Well, it turns out that the rates, we talked a little bit about them. They're unknown for the 4th quarter because we're waiting for the June rates, but the May rates, which are half of the calculation, are more than 1% higher already. So it could very feasibly be a more than 1% increase to rates in the 4th quarter, which means that most employees could be losing more than 10% of their pension. So I encourage you to go into the ExxonMobil pension modeler. If you've had a Quadro or had a break in service, it's going to be harder to do this online. You'll have to call and get a manual projection. But if you can do them online, this is very useful to model through the advanced function in your pension modeler what a 1% increase does to your pension. Or if you're not planning to retire for a couple of years, what does a 2% increase to rates do to your pension lump sum? And the rule of thumb we remember is every 1% increase to rates results in close to a 10% drop in your lump sum. Very severe impact in interest rate, rising interest rate environment. All right, looks like that's all the questions that we had for today. So we're going to wrap it up. Appreciate everybody making today's webinar series. I hope everybody has a good, safe 4th of July weekend, and we hope to talk to you all again very soon.